Great, thanks, Melissa. Hello, everyone. Welcome to our webinar today, where we're going to talk about our recent thematic research report called 10 for 2019 Systemic Risks Loom Large. My name is Doug Morrow, and I'm a director on the thematic research team here at Sustainalytics, and I was one of the co-authors of this year's report, and I have the pleasure of being your moderator for today's session. I'm joined today by my colleagues Martin Vezer, Alain Gaudin, and Casey Vosberg. And we look forward to presenting and having what we hope is a lively Q&A at the end of today's session. I'd like to begin with a few housekeeping items. The webinar is being recorded and it will be shared with all the participants after today's call. All participants on the call will be muted and we will hold all questions until the end. You can submit questions to us through the chat box in the side panel that you see there on the slide with box 1. And you can also use that box to notify the organizer if you're having any difficulties whatsoever with the GoToWebinar software. And finally, you can minimize the side panel by clicking on the double arrows at the top of the panel you see there with box 2. So just quickly, a few quick words about Sustainalytics. Sustainalytics is the world's largest pure-play ESG ratings and analytics firm. Following our acquisition of GES International last month, we have over 500 professional staff and serve in excess of 550 clients, primarily in the institutional asset management space. And our expertise covers ESG and corporate governance research, and following the GES acquisition, both engagement and screening as well. All of this is bundled into a suite of high quality pre and post investment services. So in terms of a roadmap for today's conversation, we'll begin with a quick backgrounder on the 10-4 report series. This is actually the 5th year we've been running this report, so we can provide a bit of insight into why we do this report every year. We'll then give a quick summary of the approach we took in 10 for 2019, and then we'll jump into the findings. So Martin is going to give a summary of 8 of the 10 stories, and then Alain and Casey, as our industry specialists, are going to give a bit of a mini deep dive on their respective chapters. And then we're going to conclude with a look back at our companies from last year's report, 10 for 2018. This is an interesting little feature we've been running for the last few years to see how our companies from last year's report behaved in terms of ESG as well as equity returns. And then we can quickly wrap up and move into the Q&A session at the end. So let's take a quick look at the background to the 10-4 report series. As some of you might know, this, and as I said before, this is a report we've been running for 5 years now, and it's essentially Sustainalytics' flagship thought leadership report. The reports come out in January of each year, and they're really a platform for us, both as a team and as a company, to discuss and analyze some of the big ideas or big themes that we're looking at as a research organization for the year ahead. So this year's report, again, as I said, the 5th in the series, but it is unique in the sense that it's the first one to take advantage of the ESG Risk Ratings, which is Sustainalytics' new flagship ratings product, which came out in September of last year. So as in previous years, this year's report consists of 10 standalone chapters, each of which is 3 pages long, for those of you who have seen the report already. But they actually read as stories. In some ways, we like to think of them as vignettes, because we typically start off by talking about the issue, why it matters to investors, what are the financial implications of this issue, and then we then narrow it to a particular sub-industry, and then ultimately to a particular company. So that's the model that we follow for each of the stories. Now, the subtitle for this year's report, Systemic Risks Loom Large, I mean, that obviously implies a risk-focused outlook, but we conclude each chapter by profiling a company that we believe is well-positioned to address the issues and risks that we talk about. So in that sense, we offer a bit of an upside spin at the end of each story. And final point I want to make is simply that the 10 stories are of course unique, but they can be grouped into 4 themes you see here on the slide. These are the human side of commodities, front lines of the transition economy, high stakes in the digital world, and chemistry of the future. And a final note for me before we pass it off to Martin, it's just simply, I wanted to draw your attention to the phrase unmanaged risk, because you're going to hear it a lot on today's call. Unmanaged risk is essentially the cornerstone, or the final output, if you will, of the ESG risk ratings framework. It's, as you can see on the slide, it's what's left over after you consider a company's exposure to a given ESG issue, the extent to which that issue can be managed, and perhaps most importantly, the extent to which the company is actually managing the issue. Okay, so that's the basic composition of unmanaged risk. And one other point I want to flag is a unit of unmanaged risk is equal across industries. So the new ESG risk ratings framework is actually tailor-made for both intra as well as inter-industry research and analysis. And all the stories in this year's report draw on this concept of unmanaged risk to varying degrees. So with that background in mind, I'm now going to pass you off to Martin, who's going to walk you through some of our findings.
Thank you, Doug, and hi, everyone. I'm pleased to go through the findings and also the approach that we took to zero in on the 10 themes that go through this report. So there are two steps to the process that we took to arrive at the combination of MEIs, or material ESG issues, and sub-industries. This term MEI is something that I'm going to be using repeatedly, as well as my colleagues on the line. So I just want to emphasize the nomenclature here. So MEI is material ESG issue. This is a key component of our new risk ratings. It contains many different data points, but just for the sake of this presentation, we're going to keep it at the high level of the MEI analysis. So you can see on the figure here on your screen, the MEIs that we cover in this report apply to a large segment of the global economy. One key pillar of our analysis, corporate governance, as an example, it applies across the board to 100% of the sub-industries in our coverage universe. On the other side of the spectrum, the analysis we have on the MEI carbon products and services, it only applies to about 15% of the sub-industries. But in any case, you can see across the board, the issues that we are going to discuss are systemic in that they cut across the global economy, but they materialize in unique ways for unique industries and unique companies. Well, how did we determine the sub-industries to focus on? We looked at each MEI and assessed the level of unmanaged risk associated with each sub-industry. So we took the average unmanaged risk score for each sub-industry along these different MEIs, and we decided to focus on sub-industries that are at the high level of unmanaged risk according to these different MEIs. All right, now diving into the stories. The first theme of our report is the human side of commodities, and the first story in this section, Gold Mines, Unsafe Havens, looks at the risks associated with occupational health and safety facing gold miners. We take a global snapshot of what's going on in this sub-industry and highlight South Africa as one area that is particularly prone to occupational health and safety risks. It has a disproportionately high rate of fatalities at gold mining operations. But then we also take a look at a bunch of companies from different regions to see how they differ from one to the next. You can see a sample of this kind of analysis on your screen. So Sibanya at the far right-hand side of this screen is a company that we assess to have a high level of unmanaged risk on this MEI. And of course, this is a company that has been in the news throughout 2018 as incidents around its mining facilities in South Africa resulted in 21 fatalities during the year. On the other side of the spectrum, Agnico Eagle is a company that we see favorably positioned on this issue. We find it has a low level of unmanaged risk and a low overall number of fatalities, both in terms of its employee and contractor fatalities during a study period that goes back to 2015. So when you take a look at the profile in this company, you'll see Agnico Eagle has a suite of technologies that it's applying to mitigate health and safety risks, including mine visualization, software, and automation systems to prevent exposure to employees to some of the risks of mining. The next story in this category, slavery in the seafood supply chain, takes a look at recent controversies linked to food retailers' supply chains. We take a note from a report published in 2018 by the Human Rights Watch, which picked up from analysis done by The Guardian back in 2014, looking at the Asian seafood industry. Human rights abuses are reported to be occurring both in aquaculture as well as fisheries and even some of the canning facilities. So we look at food retailers exposed to this market, and as you can see in the table, Sainsbury floats to the top as a leader in this space with low overall level of risk in terms of our broadest category of analysis. But then looking into the MEI human rights supply chain, we find it is doing quite well, especially compared to some of its other high-profile peers, scoring well on several of the indicators that feed into that MEI, though we do note it has some incidents in its track record associated with human rights violations, but that does not apply to this particular industry of seafood that goes into other aspects of their business. The next category of the report, the front lines of the transition economy, features several stories, the first of which, oil, gas, and low carbon survival, looks at integrated oil and gas producers and risks that they face in terms of stranded assets. We take a look at the setting that they're facing right now globally, with fossil fuel glut being one compounding factor across the board, but in specific markets, tightening regulations as well as mainstream investor interest is really calling attention to these concerns about stranded assets. On the figure, you'll see Mol Group, a Hungarian player, is leading this sample with a low level of unmanaged risk on the carbon products and services MEI, and you can also see the line on that figure pertains to its carbon intensity, which is also quite favorable. So looking at the profile for this company, you'll see it is working on technologies to reduce emissions from flaring operations and diversifying its product lineups. Next, we look at renewable tailwinds for utilities. This is a story about the electric utilities sub-industry, and we focus on the European market, which we think is interesting because of the increasing price of emission allowances, which went from as low as €5 per ton in 2017 to about €22 per ton today. Other factors that are coming into play include the lower levelized price of energy coming from renewable energy sources. You can see here in the figure on your screen, we have Ørsted as a leader in terms of its percentage of renewable energy. So that's the bar. It's got about 60% of its energy profile coming from renewables. Some of it is biomass, but the big play that we like here is its exposure to wind power. It's a leader globally. The company did a U-turn. It had heavy reliance on coal and other fossil fuels, but now it's moving forward in drawing on renewables, particularly wind generation and construction of wind farms. So we also plot the MEI carbon own operations. You can see that on the figure as the line, and again, it's favorable compared to some of the other companies in the sample. Helen, I'll turn it over to you now to get into the next topic under this theme.
Thank you, Martin. Good afternoon, everyone. To set up the context for this story, it is important to be aware that while solar and wind often come to mind when talking about clean energy and renewable energy in general, the top of the sector is still hydro, with 65% of all global renewable electricity sources. And aside from low carbon emissions, hydropower dams come with a lot of other advantages. It is not an intermittent energy source. It's not dependent on rare minerals. And we have developed strong expertise in this domain over decades. Now, all of these reasons make hydro a key ally in the fight against climate change. As such, we expect the growing demand for renewable energy to fuel growth of hydroelectric dams in 2019. Reports show that there's still a lot of potential in emerging markets. We can see this in the chart on the right. In 2017, East Asia and Pacific brought 9.8 gigawatt of capacity growth, and that trend is not showing any decline. However, there are major concerns about social and environmental impacts associated with dams, including deforestation and other ecosystem destruction on the environmental side. And on the social side, we see large resettling of population and the rise of water and food insecurity. Now, while a majority of these issues can be fixed with community involvement, environmental impact assessments, and follow-up measures, there's a looming risk arising from product governance issues that is not negligible. Hydropower dams are complex structures, and errors at any stage of the construction can create structural hazards that can have catastrophic consequences, as we saw with the Laos Dam collapse last summer. The incident led to widespread destruction and homelessness among the local population, which over 6,000 were displaced, and about 40 people died, not counting the 100 still missing. Although it was not the first dam incident in the region, its severe impact has put dam builders under scrutiny in Asia. Now, investors should be on the lookout for shareholder value risks. In the Laos case, for instance, companies involved face repairing costs, delays, as well as remediation and compensation costs for the locals. And because there are other players in this industry, there's a risk of losing future contracts, which needs to be taken into account. With all these issues in mind, now let's see some dam builders. When analyzing hydropower dam constructors, we find that unmanaged product governance risk tends to correspond with the scope of quality management certification, such as the international standard ISO 9001. We can see this correlation in the chart on the right. Notice how high the unmanaged risk is for SK Holdings. And this was one of the companies involved in the Laos Dam collapse. Now, if you compare this to Daewoo, which has over 90% of sites externally certified and a much lower unmanaged risk score, it's a no-brainer. Now, what makes quality management system certification so relevant here? Well, it not only brings an assurance that a comprehensive quality management system is in place, but it also makes sure it's assessed and approved on a regular basis. Going back to the companies now, so we see that Daewoo Engineering and Construction is well positioned to respond to this growing trend in Southeast Asia. And we have this opinion based on several factors. First, the company is familiar with the regions and the risk associated with it. Since 1994, it was involved in hydropower project in Laos. Then, as mentioned before, it has over 90% of the company site certified externally through ISO 9001 or other local national certifications in Korea and in the US, for example. Finally, we already see the positioning itself in this market. It's doing strategic partnerships with key players in the Southeast Asian hydroelectric power sectors, enabling Daewoo to enter major projects like the one around the Mekong River. So a company that we think is really well positioned.
Great. Thank you very much, Hélène. I just want to stop you for one sec before we go on to the next story, because I'm getting a few questions already about this. A lot of them relate to just simple methodology, like that phrase product governance. Can you just elaborate a little bit on what exactly feeds into our product governance score?
Sure. So as mentioned, we take into account the scope of quality management system certification, but we also look into product and service safety programs. Does it have management oversight? Does it have risk assessment, employee training, and a lot of other factors? We also take into account the controversies that are linked to quality and safety issues. For instance, with SK Holdings, the fact that it's involved in the Laos case has already a significant impact on its score. Now, when we say that Daewoo does well because of its high quality management system certifications, it's also relevant to put out that the company is not immune to product and governance risk. Because of these other aspects that fit into product governance, the company could still benefit from stronger product and service safety programs, for instance.
That's great. Okay, thanks for clarifying that, Hélène. So Martin, I think we can go back to you for the next batch of stories, please.
Sure, thanks guys. Okay, so we're moving into the next story that's still under the transition economy section of the report. Ensuring a warmer planet focuses on the property and casualty insurance sub-industry. We identify two fronts of exposure facing P&C insurers. So on one side, they are facing escalating costs of payouts linked to climate change driven weather events, a type of natural disaster. On the other front, they're exposed to carbon related risks tied to their underwriting and investment activities. We zero in on the Asia Pacific region because this is the most disaster prone region in the world, according to a UN report. So we scan our universe of companies in this region. You can see a selection of them in the table on your screen, and Suncorp is here at the top of our list. This is a property and casualty insurer based in Australia. We find it has a low level of risk on our ESG integration MEI. So this is an MEI that focuses on ESG integration in the financials sector. We also look at several indicators that go into this MEI, including responsible asset management. But then on the other front, to address the concerns regarding the physical risks associated with claim payouts, we have a quick look at the indicator focused on physical climate risk management, and the company also does fairly well here. So if you look at the profile on this company, you'll see that there are several features about it that we like. It's conducting scenario analysis and integrating the results of its climate analysis into its business strategy and development, aiming to really prepare for these escalating costs associated with more extreme weather events. as well as integrating ESG factors into their underwriting and investment activities. This brings us to the next broad category of the report, high stakes in the digital world. The first story in this section, the big tech gender gap, looks at the internet software and services sub-industry. So we take a look at companies in this space for several reasons. One that's really important and widely known already is that it's quite notorious for having low levels of women participating in senior leadership roles of companies. So that's one concern, but the other concern is it's got a disproportionately high rate of incidents that we've tracked here at Sustainalytics associated with discrimination and harassment. So people may be thinking of the events that occurred in relation to the Google walkout close to the end of last year when thousands of employees from different regions at Google offices walked out in protest of some incidents that occurred related to claims of discrimination and harassment, as well as some broader issues related to gender inequity. So looking at the sample that we've got here with some of the big names in this space, eBay is our top pick with an overall low level of risk by quite a margin compared to many of its peers in this internet software and services sub-industry, but we zero in on corporate governance. Gender diversity is one of the elements that we look at in corporate governance, but you can see here broadly the company is doing quite well on addressing risks related to corporate governance, and then again zooming in on some of the finer resolution indicators on board diversity and risk oversight. It's doing relatively well, and remarkably, throughout our study period here that goes back to 2014, eBay has managed to steer clear of public discrimination and harassment incidents, according to the research that we have here from our incidents team. The next story in this report shifts from the software segment to the hardware segment. We look at privacy as a product. Data privacy has become a hot issue, especially when looking at risks related to data breaches, use of personal information that software companies are collecting, but this is also a risk facing tech hardware companies. The interesting aspect of this story that we emphasize is that the tech hardware sub-industry is reframing the issue of data privacy as a source of competitive advantage. You can see here in the figure, we've got a selection of companies. Apple is leading this group with low levels of risk on the MEI data privacy and security. So we like Apple on this topic for several reasons. We see it as really leading the charge in marketing itself as a champion of personal privacy as actually a human right, is the phrase that they use. They also really work on differentiating themselves by integrating personal privacy security measures into their product offerings using intelligent tracking, prevention, and chip-based security features in some of its products. This helps with protecting information such as fingerprint data, as an example. Okay, we move into the theme chemistry of the future. This story, Coding the Future, takes a look at the special chemicals sub-industry, and we are especially interested in companies in this space that are working on green coatings. So green coatings are alternatives to conventional coatings. They have a reduced carbon footprint. They also have reduced amounts of volatile organic compounds, or VOCs. So they have benefits both for the environment and for society. We see an uptick in revenues generated by green coatings, and projections suggest that this area of the market, green coatings, will hit upwards of 119 billion by 2023. That's up from just 80 billion in 2016. You can take a look at the sample of companies that we've got here on the screen. Axo Nobel is our pick. It has already met a target it set for itself to deliver eco premium solutions across 20% of the company revenue stream. It's already met this target, even though it was a target that was ahead of a few years. So it's ahead of the pack on that. And if you take a look at the profile, you can learn more about some of the solutions that it's putting forth in this space. So with that, I'm going to turn it over to Casey, who's going to take us into the last story of the report. On to you, Casey. Oh, I think you might be muted on your side, Casey.
Oh, sorry about that. Thanks, Martin, and good afternoon, everyone. So I looked at the pharmaceutical sector, where revenues are at an all-time high and continue to outpace global GDP growth, as you can see on the graph here. But the industry is definitely not without its challenges, and many of the risks that we see for pharma companies in 2019 are closely tied to material ESG issues like human capital management, which is the issue that I'm going to talk about today. So when I say human capital management, I'm referring to a company's ability to attract, retain, and develop the staff that they need to meet their objectives. And there are really two reasons why we consider human capital management to be particularly important for pharma companies in 2019. So, like all knowledge industries, pharma relies on skilled workers to develop and commercialize its new products and also ensure regulatory compliance. But for pharma, of course, the development side is especially important because innovation is becoming harder to do well. I think a lot of pharma companies are concerned about return on innovation. And of course, there's a clear human element to these types of intangibles like innovation. And the second reason is there's also this trend that we see towards consolidation that is quite important in the pharma industry. So in the first 9 months of 2018, healthcare accounted for 11% of worldwide M&A, and we do consider this trend to continue in 2019, and also with a higher proportion of cross-border acquisitions. So with this, we can actually go to the next slide and take a look at the company that I've highlighted to discuss today, which is Roche Holdings, multinational biopharma and diagnostics company, which really stands out for its strong management in the area of human capital. Roche has a slightly above average exposure to human capital management, and this is due to its innovative business model. So about 1/4 of Roche's employees are employed in research and development, and the company spends about 20% of its revenues on R&D. Which is slightly above industry average. However, Roche has an unmanaged risk score, you can see on the graph here, of 2.3 for the human capital MEI, which is relatively low compared to its peers. And this is primarily driven by the company's strong human capital management initiatives. And so if we look into our assessment methodology for this MEI, what are we actually measuring? We're looking at a few different factors, such as the company's exposure, which I just briefly introduced, but also any involvement in incidents related to human capital. So for example, labor disputes or lawsuits related to discrimination, wages, any type of human capital related issue. Also quantitative data like employee turnover, and also the strength of a company's human capital management systems. So if we look at Roche specifically, the company has strong policies and programs on diversity, discrimination, freedom of association, but also a wide range of programs to attract, develop, and retain its people, such as leadership programs for all levels, employee engagement survey, a code for life, this coding program, which is specifically targeted at getting hiring staff with key data-focused skills. Also investments in laboratory programs around the world, like Genentech's Future Lab in South San Francisco. The company's also endorsed the UN Sustainable Development Goals, recently raised its targets for women in key leadership positions. So now the company is targeting 29% of women in these positions by 2020. And I would say that we do recognize that there's a lot of factors that go into human capital management. Companies often cite this issue as a key risk driver, and of course they spend a lot of time and energy on getting the right people, and that is challenging. So of course we're not able to capture all of the uncertainty in this area, but with our model we do capture some of the key management initiatives, and based off of this framework we are able to consider Roche to be well prepared to manage human capital related issues in 2019.
Thank you, Casey, for that. Before we move on, your comments about M&A deals seem to have really piqued listeners' interest. Can you just elaborate what you meant exactly, the point about human capital management and M&A deals? And the question specifically is, are you finding ESG factors are becoming more important in these types of deals? Can you just elaborate on that, please?
Yeah, sure. It's a good question. So there's a lot of factors, of course, at play when it comes to the success of M&As. But I would say that firm culture is certainly considered a success factor among others. And Sustainalytics has actually done a study of 250 M&As using ESG scores as a proxy for cultural cohesion. And this study found that ESG compatible deals actually outperformed ESG non-compatible deals by an average of 20% over 5 years. So, you know, this is really, I think what this is getting at is potential synergies that can happen in management style. So two companies having a common understanding of which ESG factors are a risk driver for companies, and then implementing resulting management initiatives in these areas.
Great, thank you very much for clarifying that. So we can move on, and it's back to me. So yeah, as I mentioned in the intro, we thought we would close out the discussion today by looking back at our companies from 10/4/2018. So we call this a retrospective. This is a feature we've been running for the last couple of years, and it's just quite interesting to look back and see how, or whether or not the companies that we selected last year behaved in a way that we expected them to from both an ESG and equity return standpoint. Now, this year's retrospective is a little unique because it straddles the launch of the ESG Risk Ratings in September of 2018. So what I mean by that is the report last year, 10/4/2018, was completed back in January with our legacy ESG ratings product. But then, of course, we switched to the new framework in September 2018, and we used that new framework to do this year's report. So to get around this problem, essentially what we did is map the issues as best we could, the issues we talked about last year, to our MEI framework that underpins the ESG risk ratings. So the main message, what we found is there's generally strong agreement between our outlooks for these firms that you see on the slide back in January and how they're performing today using our new framework. Last year, we took a positive outlook on 6 firms and a negative outlook on 4 firms. You can see the positive outlook firms there with the green arrows, negative with the red. And of the 6 companies for which we had a positive outlook back in January, 4 of them are currently assessed as having low levels of unmanaged ESG risk, and 2 have medium risk. And of the 4 companies for which we had a negative outlook back in January, 1 is at high risk today and 1 is at severe risk. So we would definitely see these as being in agreement. I think what's interesting are the 2 cases where we had negative outlooks for firms in January of last year, and these firms today have low levels of unmanaged risk on the MEI in question. So that's Coca-Cola and Embraer. So we dug into these a little bit to see what was going on, and without getting into too much detail, essentially what we found is the disagreement is primarily one of methodology. So the outlooks from last year were largely based on how we expected companies to manage the ESG issue in question. So it was looking at policies and programs and things like that. But as we've explained, these types of efforts they constitute only one branch of the ESG risk ratings. Indeed, the whole concept of unmanaged risk is it looks at gross exposure, as well as the extent to which certain issues can be managed and are indeed being managed, if that makes sense. So the disagreement is primarily one of methodology. And then from a financial return point of view, I mean, we include these numbers largely for illustrative purposes. I mean, clearly a lot more work would have to be done to figure out to what extent these were driven by ESG factors at all. But we did find that 5 out of the 10 underperformed the global market, and 5 outperformed, and there was no clear relationship in terms of performance within the green arrow companies or the red arrow companies. Great. So I think with that we can wrap up. I just want to thank everyone once again for attending today's session. I want to sign off before we get to the Q&A just by saying that we hope this report delivers value to our clients. We think that it provides potential investment ideas or engagement themes for investors to explore in 2019. We think it could potentially deepen investors' understanding about some of the possible financial effects of MEIs, in particular subindustries, and perhaps even, this report could even provoke new thinking about some of the most pervasive MEIs affecting the global economy. So thank you, and I think with that we can transition into the Q&A session. So I've been sort of tabulating and collating questions as we've been going, so let me just refer back, but definitely we have quite a few to get to. Ellen, one question here, it's a bit of a technical question. It says, Daewoo, while Daewoo uses ISO 9001, do you guys look at ISO 14001? Do you consider these to be equal value? Is that something you've looked at before in your analysis?
Thank you for your question. So we do look into ISO 14001, but in the context of other indicators and other MEIs. For instance, when we are looking into emissions, effluents, and waste, for instance, we do assess ISO 14001. We also look into other types of certifications. There was OSHA 18001 that is now replaced, I believe, recently by an ISO, and we do value them at with a similar quality, at the similar level, let's say. But then again, because these are very specific standards, they are associated with the MEIs that where they fit the best. I hope that answers your question.
Yeah, I think that's helpful. Thank you very much for clarifying that, Ellen. We've got one here, a bit of a pinpointed question here for Martin, talking about the gold miners, the story number of fatalities. You talk about overall numbers. Did you consider normalizing to show the fatalities per hours worked?
So I think that's referring to the figure that we showed with the companies. I'll just go back to the story here. We have the overall number of fatalities associated with these different miners plotted with the line. And so in this part of the story, we look at absolute numbers, but in the introduction of this story, we take a look at some findings that normalize by number of hours worked. So we drew on the ICMM analysis. So that in that sense, we're looking at a normalized number. Here in this figure, we could have used a normalized number. Here at Sustainalytics, we do it a little bit differently, and we didn't want to normalize in two different ways in one story. So we could normalize it by number of employees, as an example, but the time frame that we look at and the particular normalization technique that we apply is different than the ICMMs. So here we just wanted to keep it simple and just show the overall number. But yes, you could definitely apply a different metric here and normalize for this type of work.
Great, thank you very much for that. Casey, I've got one here for you. It says, you're studying statistics about women in leadership at Roche. Can you just briefly elaborate on the benefits of gender diversity in executive roles?
Yeah, sure. So there are several different studies being cited recently about the benefits of women in leadership. I think Sustainalytics actually released a paper in 2018 that highlighted a few of them. There's two that I like to cite. There's a Credit Suisse study of 3,400 companies, which showed that women that comprise 15% of companies where women comprise 15% of senior management had 50% higher profitability than those where women made up less than 10% of senior management. I think there was a similar study by Pearson, including 22,000 companies, which showed that increasing women in leadership positions by 30% could add 6 percentage points to a company's net margin. So there's many studies in this area. There's a lot of investor interest here as well. I think that in general, the evidence shows that promoting equality and diversity in the workforce can bring benefits to businesses in many areas, and from the human capital side in recruiting and retaining talent, but also related to innovation and decision making and other key activities, which of course for pharma and for any knowledge-based industry is of key concern.
Sure. Thanks for that. I actually got another one for you here about the M&A deal. Again, those comments seem to have generated a lot of interest, which is fantastic. The question is, can you give an example of an M&A deal and tell us in the pharma sector and tell us how it might play out in terms of human capital? So I guess that's predicated on maybe some deals that you're following. Can you talk about that at all, please?
Yeah, definitely. So one of the biggest deals we've seen recently was Takeda, a Japanese pharma company. They acquired Shire for $62 billion. That was Shire is a leading biotech firm, and this would propel the combined company to 9th place in terms of revenue. If we look at ESG compatibility here as an indication of cultural cohesion and really as a potential success factor in this deal, I would definitely say that they're well positioned because these companies do have similar overall ESG performance. Even if we zoom in specifically to human capital, they both have average or above average human capital management initiatives, which would in general give us a low risk view of this MEI. So, of course, firm culture, it is difficult to measure, and I think there's some cultural elements, certainly with a Japanese and an Irish firm, that are not going to be captured by our measure of cultural cohesion. But if we look at the management side, these companies do have similar management of ESG issues. So from this perspective, I would say that the combined entity is in a good position.
Great, thank you for that. Ellen, I've got one here for you. The question is basically whether or not we look at water supply risk due to climate change, whether that's factored into the risk metrics for firms in hydroelectric dam construction and operation exposure. So basically, whether or not we look at possible changes in water flow rates as a result of climate change when we evaluate those types of companies. Is that something you can respond to? Have you looked at that before?
We look into the, this would fit under the environmental and social impact of products and services. So we would look into, we have some indicators, I mean, that deal with water risk management, that deal with, is the company operating in water stressed areas. This is something that we take into account, but in the case of hydroelectric dams, in particular for constructors, I'm not sure it's something that we specifically focus on, but I could get back on the person asking the question after looking into this in more details. That's it. So we do look into that, but then it's different in the way it fits into the risk rating, let's say, in the different MEIs.
Yeah, no, I think that's helpful, like mentioning those indicators and in the water stress regions, etc. That's helpful, thank you. Martin, so what do we have? 8 minutes left. We'll try and squeeze these in as best I can. Martin, I believe this pertains to you. The question is about APAC. You referred to it as the most disaster prone in the world. How exactly do you measure that?
Yeah, that was for the insurance story. So we focused on APAC in the story, as I mentioned, for a few reasons. One of them, and probably the main reason being, Asia Pacific is considered the most disaster-prone region in the world. So that's a soundbite that's coming from a United Nations study, and you can find the reference to it in the report in that section. So that study looks at the different types of disasters, not just weather disasters. So you can also consider earthquakes, for example. And in terms of losses, it goes beyond just financial losses. It also deals with displacement of people. So that's maybe a broader claim about the disaster proneness of the region than one might want to look at when thinking specifically about financial risks associated with disaster. But APAC is also prone to weather-related disasters that do have high levels of financial loss. So it is a financial story, but that particular claim is a bit broader. And you can unpack that again, we cite this other study in the report that has a section that dissects the losses across different regions. And you can see, the US, for example, has really high losses when it comes to the insurance industry. And a lot of that is due to the value of the infrastructure.
Great. Thank you very much, Martin. Casey, I think this one would be for you. It's what is the source that we use for measuring number of harassment and discrimination incidents in the tech sector?
In the tech sector, sure. So that would come from our incidents research. So we have an entire team that is responsible for screening I think we screen over 80,000 news sources every day. And in order to find any controversy related to any company in our research universe. And then we populate this database of any incident, which is a record of a company activity that has a negative impact on stakeholders. So we have our own database, actually, of any sort of corporate incident, and we use this to feed into many parts of our research methodology. And here you can see some of the some data about incidents related specifically to discrimination or harassment for each of these companies listed here. So it could be a wide range of sources. Yeah.
Right. Okay. No, that's helpful. Thank you very much. Alain, I've got two here talking about the Laos Dam collapse that you mentioned, and then obviously top of mind these days would be the Vale's tailings dam collapse a couple of weeks ago. And I think you alluded to this in your story, but do you think these sorts of catastrophes are going to lead to any sort of new regulatory scrutiny for hydroelectric dams in Brazil or elsewhere?
This is actually a difficult thing to anticipate when it comes to regulatory scrutiny, because so the company involved in the latest dam collapse in Brazil, the tailings dam, was Vale, which is actually surprising because they were also the one involved in the Samarco Dam failure in 2015. So you would assume that after a big disaster like the one in 2015, there would be regulatory changes or even measures from the company, but it wasn't the case there. We see a lot of cases when the issue is not necessarily the quality and the regulatory environment or the quality measures of the companies, but it has a lot to do with bribery and corruption, which is often really intertwined with these kind of big projects. Hydroelectric dams are projects with governments a lot, and it's in countries that are highly exposed to bribery, it's something that happens. So when auditors would come, there could be there's events where there's bribes. So even if there's an issue and the regulatory framework is here, it kind of passes by. Another thing to keep in mind is that even in areas where regulatory framework is adequate, and there's authorities that find quality breaches, that fine companies, sometimes companies would prefer paying smaller fines on a regular basis than fixing the issue. Because, for instance, for hydroelectric dams or other big projects, the overall cost of just paying some fines is lower than causing disturbance from the production and doing reparation works. So, I mean, there's a lot of groups advocating for greater regulations and increased regulatory scrutinies for these big projects, but there's so many other factors that play and that need to be taken into account when it comes to these big dam collapse and catastrophes. So it's there's a lot of things to take into account. We do take into account quality in the MEI. We have another MEI specific for bribery and corruption, and we take into account the fines that companies have to pay. Like Casey mentioned, we have our incidents team that's on it that reports when companies are paying fines or when they're being investigated for quality breaches or similar things. But in terms of anticipating regulatory scrutiny, unless there's a stance from governments, like we saw in Laos, the government really took a stance and said, we're going to re-audit big projects, we're going to look more into quality, we're going to pay more attention to this. In Brazil, it hasn't been the case yet. So it's difficult to anticipate when the government hasn't taken a stance.
Right. Okay. Well, that's a very insightful and thoughtful response. Thank you. Thank you, Helen. So I think with that, we are at time. We did not get to all the questions, but we will follow up offline with all the questions, the participants whose questions we did not get to. So let me just say once again, thank you for your attention today. Thank you to Martin, Hélène, and Casey for their presentations. And we look forward to hosting you again on one of our upcoming Sustainalytics webinars. Thank you.